this recording, I'm going to be working through the mock test Healthstone Limited. Please make sure that you have attempted this question under exam conditions before watching the recording.
Right, guys, so we've got 15 minutes available to read through the information provided in the scenario. And whilst doing that, we are going to identify positive and negative factors. All positive factors we'll mark off with a tick, and all negative factors with a cross. All right, so let's work through the information provided. Healthstone Limited, or Healthstone, is an investment holding company which operates through a number of subsidiaries. The company's ordinary shares have been listed on the Johannesburg Stock Exchange in South Africa since January 1992. All right, so the fact that their shares are listed on the JSE is obviously a positive factor or a positive point. If the company needs to raise finance in the future, it's easier for them to raise finance than an unlisted company. The Healthstone Group provides private hospital services across South Africa. All right, so that's what Healthstone does. They provide private hospital services across South Africa. The group's capacity, expertise, and experience positions them to make a substantial contribution to the successful implementation of National Health Insurance, or NHI. They are committed to partner with government to find and implement shared solutions to deliver quality healthcare to more South Africans. All right, guys, so that's obviously also very positive. The fact that they are committed to partner with government to contribute to the successful implementation of NHI because they have capacity, the expertise, and the experience to do so is very positive. Healthstone is continuously exploring ways to improve its service offering to patients and has recognized the growing demand for mental health care services in South Africa. The management of Healthstone has indicated an interest in acquiring 100% of the ordinary shares in Springfield Medical Clinic Pty Limited, or Springfield. Springfield was established in 2005 and has a wide network of 12 psychiatric hospitals located in various parts of South Africa. They offer specialized treatment of adults and adolescents for a range of psychiatric, psychological, and addictive conditions. Strategically, this is an ideal fit for Healthstone, and post-tax synergy benefits of 650,000 Rand per annum at current prices are expected to materialize. Healthstone will make use of existing cash resources to fund the acquisition. All right, guys, so we've got Healthstone interested in buying 100% of the ordinary shares in Springfield. And Springfield is just a network of psychiatric hospitals. So they have 12 psychiatric hospitals across South Africa. Now, guys, the fact that Healthstone is continuously exploring ways to improve its service offering. If they purchase 100% of the shares in Springfield, they will be improving their service offering to patients because they can now help patients with mental health care services. So the acquisition would obviously be positive from that perspective. In addition to that, if they buy 100% of the ordinary shares in Springfield, we know that there is a growing demand for mental health care services in South Africa. So if there's a growing demand and more people are making use of these psychiatric hospitals, then Springfield should be profitable in the future. And if Healthstone buys 100% of the shares in Springfield, they will obviously be able to benefit from those growing profits in the future because this is a growing industry. Then something else that's important to note in this paragraph is Healthstone is going to make use of existing cash resources to fund the acquisition. Now, guys, this could potentially be a negative point or a negative factor because it could have a negative impact on Healthstone's cash flow or liquidity position. Let's continue reading. Lesego Banda, the co-founder and managing director of Springfield, will continue to manage the business within Healthstone after the acquisition. Now, that's obviously a positive point or a positive factor because somebody who's familiar with the operations of Springfield or who has the required skills and knowledge will still be involved after the acquisition. So we don't need to worry about whether Healthstone has the required skills and knowledge to run Springfield, because Lesego will still be involved. Springfield made an important contribution to the provision of mental health and psychiatric care in South Africa when they introduced a new behavioral therapeutic model that has shown to be effective with patients suffering from depression. The therapeutic models developed by Springfield have been recognized as intangible assets. All right, so there's a few things that we need to discuss over here. First, this new behavioral therapeutic model that has shown to be effective with patients suffering from depression. This could be positive from a social perspective because this model could help improve the lives of patients suffering from depression. So from a social perspective, it is positive. However, in addition to that, it could also be positive from a financial perspective. Because if this is helping patients suffering from depression, it could result in increased occupancy levels in the psychiatric hospitals, which would result in improved profits for Springfield. And obviously, if Healthstone purchases Springfield, they will be able to benefit from that increase in profits. Then, in addition to that, guys, the fact that these therapeutic models are recognized as intangible assets. Here, there's a risk that these intangible assets might be overvalued, or it might be difficult to determine the fair value of these intangible assets in the case of any acquisition. So there's a negative aspect over there. During 2017, one of the psychiatrists employed by Springfield made an improper diagnosis. And as a result, the patient was administered the incorrect treatment and medication. The patient's family has indicated that they intend to take legal action against Springfield for malpractice. All right, so that's obviously negative. There's a risk here of lawsuits, which could also create reputational damage as a result of malpractice. In terms of a recent broad-based Black economic empowerment verification, Springfield was rated as a level 6 contributor. Right. Now guys, remember level 1 is the highest rating, a level 8 is the lowest rating, or you can be completely non-compliant. So a level 6 contributor is not a very good BEE rating. This is a very low rating. And the significance of this, guys, is if you go back up, we were told that Healthstone is committed to partnering with the government to find and implement shared solutions to deliver quality healthcare to more South Africans because they want to be involved in the NHI. Now, obviously, if you want to partner with government, you need a good BEE rating. So if they acquire Springfield, Springfield has a very low BEE rating, and that could have a negative impact on any future partnerships with the government or any contracts when it comes to NHI. We then have financial information relating to Springfield Medical Clinic Pty Limited for the year ended 31 December 2018. So there's property, plant and equipment, current assets and current liabilities. Included in current assets, so included in that amount over there, we have cash and cash equivalents to the value of 1.86 million rand. Post-tax operating cash flows were 80% of earnings. A dividend of 420 cents per share was declared during the 2018 financial year. In terms of the group's dividend policy, a constant dividend payout ratio of 40% is maintained. So Springfield pays out 40% of their earnings as a dividend. Springfield has 1 million shares in issue. Springfield entered into a loan agreement on the 1st of January 2016 for an original amount of 20 million rand. The interest rate on the loan is 1% below the current market-related rate of 10%. All right, guys, so remember, if the market-related rate is 10%, that is the cost of debt. and the interest rate on the loan is 1% below the market-related rate. So the interest rate on the loan would be 9%. So that is the rate that you would use to calculate your interest cash flow. That is the coupon rate. So remember, don't confuse these rates. If we are trying to calculate the interest that is payable on this loan, we would use the 9%, the coupon rate. That's what you use to calculate the interest cash flow. However, the market-related rate, the 10%, that is the cost of debt. And remember, if you need to calculate the market value of debt, which you won't need to because you can see just below, the market value of the loan on the 31st of December 2018 is 15 million rand. So you have been given the market value of the loan. But if the market value of the loan is not given, remember you use the cost of debt as your discount rate when calculating the market value. So make sure you understand the significance of those two different rates that you've been provided with. Springfield holds preference shares in Lannister Limited with a nominal value of 4 million rand. The preference shares carry a 15% dividend, which is payable annually in arrears, and they are not redeemable. So we are dealing with non-redeemable preference shares. And you've been given the coupon rate here. The preference shares carry a 15% dividend. So once again, guys, the 15% is the coupon rate. And remember, we use the coupon rate to calculate our cash flow. So we'll use this coupon rate to calculate the dividend cash flow. So dividends would be payable at a rate of 15% per annum. And then you are also given the fair rate of return for preference shares with a similar risk profile. So that is the market-related rate, or the rate of similar preference shares, meaning that is the cost of the preference share. And you use the cost as your discount rate when calculating the market value. Springfield's applicable beta coefficient is 1.4. They have a target debt to equity ratio of 0.25:1. Legal and other acquisition related costs at present value are expected to be 2.5 million rand. You are then given forecasts for the future. Post-tax operating cash flows are expected to increase by 6% per annum in real terms for the next 3 years. So guys, you are specifically told that the post-tax operating cash flows will increase by 6% per annum in real terms. And if that is in real terms, it means that we are ignoring inflation. All right, so be careful. If you are specifically told that something is going to increase in real terms, that means inflation has not been taken into account. So post-tax operating cash flows will increase by 6% per annum, ignoring inflation. Then, net working capital and capital investments should maintain a constant ratio to operating cash flows after tax until the end of 2021. Free cash flows are expected to grow at a constant rate of 8% per annum after 2021. We then have some industry information. The current rate of inflation is 5% per annum and is expected to remain at this level for the foreseeable future. The current risk-free rate of return is 6% per annum, and the current market return is 14% per annum. The corporate tax rate is 28%. All right, guys, so that's all of the information that you've been provided with in the scenario.